Welcome to part 2 of our tax planning after a spouse dies. So remember, last time we showed you we had a woman whose husband died in April of 2018, and she had until the end of the year in which to file married filing jointly. And her accountant was saying no reason to do anything differently, just keep on keeping on. And that's where I took a huge exception to that. And I'll show you here right now the difference between married filing jointly and a single taxpayer, i.e. a widow taxpayer, the exact same thing. So now what we're going to do is we're going to fast forward into 2019, and I'm going to show you the exact same circumstance, what happens in 2019 as she's a single person or a widow, again, they're synonymous, versus what would have happened last year if she would have taken advantage of the tax code to increase her income while she was married filing jointly. So remember, we have, what happens is the husband has $1,700 a month of pension or Social Security. She had $1,300 a month of Social Security. When a surviving spouse, when a decedent dies, all right, the surviving spouse can get either, or the deceased dies, the husband dies in this case, the surviving spouse can get either the greater of her own benefit or his benefit. In this case, the greater would be his benefit. So she loses her benefit, but she captures his instead. She does lose $1,300 a month, but she will step into his benefit and get the $1,700 a month instead. Now, she also has a pension of $2,000 a month, which is from the town. So that's her income. That's it, a pension and her husband's Social Security. It was called a survivor benefit, okay? A pension plus her survivor benefit. Those two together are $3,700 a month. You times that by 12, and her income is $44,400. All right, so in 2019, her income is $44,400, which is more than enough for her to live on, is what she told me. All right, so the first thing we got to do is we got to figure out how much of that Social Security is subject to taxation. And if you follow my videos, you recognize we need to find out her provisional income, which is the amount of your Social Security that's subject to taxation. Now, here's where it starts getting tricky. For a single taxpayer, the provisional income rules are different than they are for a married. So for a single taxpayer, between 0 and 25,000 of your provisional income is a big fat goose egg when it comes to taxes. Then from 25 to 34,000, 50% of that amount is subject to tax. And then anything above 34,000, 85% of that amount is subject to tax. For a married couple, 0 to 32,000 is free and clear of any taxation. 32 to 44,000 is taxed at, or 50% of that amount is subject to income tax, and anything above 44,000, 85% of that amount is subject to tax. So you can see it's a lot more favorable for married filing jointly just on the provisional income alone. So now we got provisional income of 44,400. We have provisional income. No, oops, I got to change this around. I was going to show you. So what we got to do here is we got to figure out what our provisional income is. All right, so what we do is we take half our Social Security benefit and we take all of the pension. All right, so, or all of the other income. So we know for a fact that we're going to have a pension of $24,000, which the entirety of that will go into our provisional income. Then we got to take half of our Social Security benefit, and that will be 1,700 times 12 divided by 2, 10,200. So her provisional income would be 34,200. I just want to caution you folks, when you're calculating this, as I just did, it's easy to forget to figure out provisional income relative to what your total income is. This is your total income, which is not the same as provisional income. You got to take half of your Social Security. I literally just made that mistake, and you just watched me fix it. So you always got to remember the difference between total income and provisional income. You got to half your Social Security so that way you can figure out how much of your Social Security benefit is subject to taxation. Easy to overlook this. Many, many, many people do. It's easy. So, all right, so now we got provisional income of $34,200, all right? 34,200. So the first 25,000 is free and clear of any tax. The next 9,000 $4,500 that's subject to taxation, and then the amount above 34,000 is 200. It's going to be 170. So her taxable Social Security will be that's her taxable Social Security, 4,670. So let's keep going. Get my trusty calculator here. Joop, joop. Got to clean up the board, make it look nice and sharp. So remember, taxable Social Security, $4,670. Now we got to figure out our AGI. Let me dry it off a little bit more. We got to figure out AGI. All right, so in this case, we take our taxable Social Security, which is $4,670, plus our pension, which is $2,000 a month, $24,000. Add them together, our AGI, adjusted gross income, is $28,670. Now, as a single taxpayer above the age of 64, she gets a $13,600 standard deduction. Which leaves her with taxable income of $15,070. All right, now for a single taxpayer, roughly the first $9,500, and this is going to be too specific, is right around there, is 10% bracket. So, and again, I think it's 97. I can't remember off the top of my head. Frankly, it doesn't matter that much here. But basically, the first $9,500 will be subject to 10%. And then anything above 9,500 to roughly 37,000 is subject to 12. So we take 15,000. 15,070 minus 9,500. That's 5,570 times 0.12, 6680. It'll be here $668. So we take $950 plus $668. And her taxes are $1,618. So that's what she's going to pay in taxes on, let's see, she had $44,400 of income, which is a taxable income of $15,070. Before she had more, I can't remember off the top of my head, but she had taxable income before when she was alive of negative $200. She paid no tax, but she had a whole lot more income than she did here because she had an extra $1,300 times 4. She had an extra $5,200 of income because while she was still alive, she had her husband was still alive. She had her Social Security of $1,300 a month for 4 months when he died, and then she dropped that and just got his. But at the end of the day, she had over $5,000 more of income, of total income, when her husband was alive, and yet she paid no tax. Now she has $5,000 less of income, and even though she has $5,000 less of total income to spend, her taxable income went from zero, negative $200, to $15,070, and her taxes went from zero to $1,618. Crazy. So I want to write this down. Because what we're going to do is we're going to use this for another video to show you what happens if she did a Roth conversion here too. So again, we have single taxable income, $15,070, tax, $1,618. But the accountant says don't do anything until the following year. If she did nothing, just having done nothing, she's going to pay more in taxes next year. Absolutely. So, I mean, yeah, she could say, yeah, it's great, I don't pay any taxes for this 1 year, but I'm not going to do anything. And so next year she's going to have to pay $1,618 tax on $5,000 less in income. But stick with me, my friends. It's going to get worse because I'm going to show you what happens again if she does a $10,000 distribution from an IRA. And I keep saying Roth. You don't have to do Roth. Just an IRA distribution is the exact same thing. You can take it out and burn it in the fireplace. You can take it out and convert it to a Roth. It doesn't matter. As long as it comes out of your IRA, you are going to pay tax on it. So stick with me and I'll show you next time. Thanks, guys.